Hey everyone, my name is Sherman, a CPA here at LYFE Accounting, where we help you save on taxes and increase your wealth. Look, today we are going to talk about how to pay yourself as a single member LLC step by step. I am going to explain who is a single member LLC, how these types of LLCs pay taxes, and most importantly, how to pay yourself from this type of LLC. Now, this is a very important topic because single member LLCs work very differently from multi-member LLCs, partnerships, and other types of entities. Therefore, it is important that you know how to pay yourself correctly from this entity type in particular. So if you are the sole owner of your business, meaning you have no partners at all, then this full video was made for you. So if you are ready to begin, go ahead and like this video to help us spread the word, and be sure to subscribe if you don't want to miss out on more tax and wealth related videos. All right, so what is a single member LLC? A single member LLC is an LLC with one owner. So if you own 100% of your business, then you are likely operating as a single member LLC or sole proprietor. And a sole proprietor works the exact same way as a single member LLC for tax purposes. But the major difference is that you have more liability protection under an LLC than you would as a sole proprietor. For example, if you own real estate and your tenant slips and falls and hurt themselves, they can sue you. And if you own the real estate as a sole proprietor and lose the lawsuit, then that means they could come after your personal assets. However, if you own your real estate through a single member LLC by just incorporating an entity to own your real estate, then your losses would not extend to your personal assets. You can create a single member LLC to operate almost any kind of business, and it is the most popular entity type today. Now, let's go ahead and talk about how taxes work for single member LLCs, which will help you understand how you should pay yourself from your business. Okay, so let's start with the basics here. In any business, all the money you received is considered taxable by the IRS, and all the expenses you incur to operate your business are deductible so long as those expenses are reasonable and necessary to run your business. So to find your LLC's taxable income, all you would need to do is take your business revenue minus your business expenses, and you will arrive at your business net taxable income. Now, it is important that you understand that the money you pay yourself from your business as a single member LLC is not an expense. It is not tax deductible. The money you pay yourself from your LLC is irrelevant for tax purposes. So let's say your business earned $100,000 in profits and you did not take a penny out of your business bank account. Well, guess what? You are still going to pay taxes on the full $100,000 that your business earned. And if you pay yourself $50,000 out of the $100,000, then you would still pay taxes on the full $100,000 in income. When you operate as a single member LLC, you are not an employee of the business. Therefore, in the eyes of the IRS, all the money the business makes is yours. You are not a 1099 contractor in your business either. Your customers might issue you a 1099, but that just means you are a vendor of their business. They're just writing you off as an expense to their business, but you are not an expense to your own business. So when you file your taxes, you cannot deduct yourself. Single member LLCs are considered disregarded entities in the eyes of the IRS. What this means is that the IRS does not consider your single member LLC as a separate business for tax purposes, which also means that you do not have to file a business tax return when you file your taxes. Instead, you will file a Schedule C to attach to your personal tax return, which is just a supplemental schedule that you will add when it's tax time. Now, this is a good thing because business tax returns are generally more expensive. For example, I just did a quick Google search and the average cost to file a corporate tax return starts at $850, while the average cost to file a Schedule C is around $500. And not only are your tax returns cheaper under a single member LLC, but you also have more time to file your tax return. Since you are filing as an individual, you only have to file by the individual tax deadline, which is about a month after the business return deadline. Normally, the deadline for filing a business return is March 15th, and personal deadlines are normally April 15th. So by filing as a single member LLC, you save money on tax preparation fees, and you have more time to file your return. But now let's talk about the main types of taxes you will pay as a single member LLC. There are three main types. Number one, federal income taxes. Number two, state income taxes. And number three, self-employment taxes. Because single member LLCs are disregarded entities, the money your business earns will flow through to you, to your personal income, and that means you will have to pay federal and state taxes on your total personal income, including your business. For example, if you earned a C corporation in 2021, and earned $100,000 in income from your business, your corporation would pay a flat tax of 21% on the income. But if you earn $100,000 as a single member LLC, that money will be taxed in increments based on the personal income tax rates up to 24%. And if you have multiple streams of income, your combined income could raise your incremental tax rate up to the maximum individual tax rate, which right now is 37%. Now, the only tax that will specifically apply to your business income as a single member LLC would be the self-employment tax. The self-employment tax is a 15.3% tax on your business income. This tax in particular is the one that catches most people by surprise when they see their tax bill. Because in addition to all of the federal and state taxes you pay as an individual, the 15.3% self-employment tax would add another $15,000 in taxes on $100,000 in income. Now, fortunately, you can avoid this self-employment tax by filing as an S-corporation. An S-corporation does not pay any self-employment taxes at all. And the cool thing about S-corps is that you can remain a single member LLC for legal purposes, but file as an S-corporation for tax purposes. But keep in mind that there are also additional rules with filing as an S-corporation, like the requirement to pay yourself a reasonable salary, which is subject to payroll taxes. But still, once your business is earning over $50,000 in income, it normally makes sense for most businesses to start filing as an S-corporation to minimize their self-employment tax. For more information on how S-corps work, make sure you subscribe to our channel. And if you have any questions, just drop me a comment below. Anyway, for now, let's assume that you are not an S-corp and discuss the steps you should take to pay yourself as a single member LLC. So here are the steps. Number one, operate out of a business bank account. You do not want to commingle your business funds with your personal funds. Trust me, it's going to make bookkeeping and finding the correct tax deductions for you during tax time a nightmare. Furthermore, it can also complicate things if you get audited by the IRS. Because if that happens, somehow they're going to have to make sense out of all of the tax deductions you claimed. And if this is not very clear through your bookkeeping, then you can get yourself into some serious trouble. All right, number two, transfer money from your business bank account to your personal bank account. You can write yourself a check, you can wire funds to your personal account, or you can go straight to the bank and just take out cash. Remember, the money you pay yourself from your business is your business. Your taxes are going to be based on the business overall profits, not by how much you pay yourself. But does this mean you should take all of the business profits to pay yourself? Probably not. So let's move on to step three. Number three, pay yourself, but don't hurt your business in the process. A lot of business owners make the mistake of paying themselves too much. They don't leave enough money in their business, and then they find themselves going into debt to fund their operations, or just flat out going out of business altogether. And a lot of the times it is because they are taking too much money out of their business. So when it comes to paying yourself from your business, you need to think about your cash like fuel. If you run out of cash, then you are on E. The game is over. You want to keep enough fuel in your business so you can make it to where you are trying to take it or grow to. So with that said, here's my framework to make sure that this always happens. Rule number 1, leave 3 months of operating expenses in your business. Now this will be your safety net. If you always leave 3 months of operating expenses in your business, then you will be able to stomach most sudden or unexpected expenses that may come up. Rule number 2, put aside money to pay your estimated taxes. As a single member LLC, you are required to estimate the amount of taxes you will pay each year and make quarterly payments to the IRS for those amounts. Now, a lot of people think this is optional, but it is not optional. You can be assessed penalties and late fees for failing to pay your estimated taxes. So put yourself on a schedule to pay your estimated taxes quarterly and also leave that amount in your business to do so. Rule number 3, put aside money to reinvest in your business. If your goal is to grow your business, then chances are that it's going to cost you some money to accomplish this, especially if you want to grow your business quickly. So whether that's upgrading your equipment, hiring employees to help you, or developing some type of software or process, be sure to leave this dollar amount in your business. And rule number 4, pay yourself everything that is left. If you have money set aside for the first 3 things, then go ahead and rob the bank of everything that is left over. It is your money and you earned it. And most importantly, you can have peace of mind and not worrying about Uncle Sam or your ability to pay your bills on time. Let me know what you think about this and if you have any questions in the comments below. I'll see you in the next video.